Hello, everybody, and welcome. My name's Eric Bird. I'm your host here at StopStrugglingNow.com. And today, we're going to talk about merch. That's right, promotion, merch. And what else we're going to talk about is dividend incomes. One of the 7 streams of income that we keep talking about. Dividend income. So please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it.
All right, welcome back. Well, ladies and gentlemen, something they don't teach you in school, they neglect to teach you in school. Why? Because the wealthy have to stay wealthy. This is how Warren Buffett does it. This is how Microsoft, Bill Gates does it. This is how millionaires and billionaires and people who make a lot of money does it. If you can invest one time and still reap rewards of additional money in your account, wouldn't you take it? There's a reason why they want the stock market to always be going up. There's a reason why they have to manipulate the stock market, because that's where a lot of wealthy people keep their money, that paper money. The reason why? Dividends. So you can see on the screen. What we're talking about today is we're going to talk about 12 months that you can receive dividend income. What that means is when you invest in a stock, a share, they send you money every 3 months. So literally, you can have a dividend check coming to you every month, every year, like Warren Buffett. He's the most famous person for investing, and he always invests. You've heard him say Coca-Cola, Geico, things like that. There's a reason, because once he makes an investment, whether the stock goes up or down, the company is still paying out dividends, and dividends is money, actual cash. Stocks are paper. They're basically worthless, just like money. It's just that you make them a value. So once you learn about this, what I'm talking about, then you can say, all right, now let's get down to business. And don't be confused. Here's where people get messed up. They think you need 2,000, 5,000, 15,000. In the old days, when you used to open up a brokerage account, they would have a minimum amount of money that you would be able to put in there. That's why most people were doing mutual funds. But mutual fund companies, what they don't tell you is they're doing exactly what I'm about to show you right now. They're investing your money in these dividend stocks, then charging you 1 to 2% every year on your money just to do nothing. So just keep in mind, you can do this all yourself and you can keep it to yourself. But first, we're going to talk about the tax implications, because that's another fallacy that people believe, that once you start making money that you got to pay all these taxes. That's another reason why the big boys like dividend income. There's lots of reasons. So we're going to talk about this right now, the tax implications. Most people, 60% of Americans, make under $40,000 a year. Guess what? Your dividends, what they call capital gains money, you pay 0 in taxes. And if you are married, both you combined make $77,000 or less, any dividend income that comes in, you pay 0 in taxes. That's 60% of America can be paying 0 in taxes for the dividend income. And we're talking about, you've heard me in previous videos talk about AT&T, recession-proof yourself, because AT&T stocks were around 34, 33. I think they went up to 40 now. But the price of the share really doesn't matter that much when they're paying you 50 cents every 3 months for every share that you own. So that's how you reinvest that money. But we'll get into that in a second. The basics of dividend taxes. Here we go. This is what I'm talking about. This is 2018, but also in 2019 tax year, it's still the same. So you can see right here, individuals who make less than 38,000 and married couples who make less than 77K on qualified dividends or long-term capital gains, you're not going to pay anything. All right? here's where the thing comes in where you have to pay. Once you start making over 38,000, let's call it 40 grand, but 40 grand to 425,000, and ladies and gentlemen, you know if you're making $400,000 a year, you're in the 1 percentile. So you're not going to care about paying a little tax, and which is 15% of your dividend money, free money that you're getting in for a one-time investment, passive income. This is how you build wealth for you and your family. And by the way, you can package it up to pass along to your family members. Estate. This is how people have estates. This is how people are saying, how does Rockefeller, Carnegie, Kennedy, how do these guys all have generational wealth when they've been dead for 60, 70, 100 years? Well, guess what? They have these things called stocks, dividends, trust funds, and they have this money. And keep in mind, when you have hundreds of millions of dollars, these guys have hundreds of thousands of dollars of dividend money rolling into their estates. Never mind, they're rich and famous and they still have intellectual property rights coming in, paintings or whatever else, museums and things like this going on. But we're sticking with ordinary individuals, OCs like us. So if you make between 40K and 425K, your tax rate on any dividends that you cash out is only 15%. How many of you make earned income right now where you work at a job? Have you really looked at how much tax they take out of your money? Sure, if you make under like a certain amount, what is it, 30,000 a year, I think, you pay little to no tax. But they still take out something. So here we are where you can reinvest your dividends, meaning you're not even going to be liable for your taxes at that point. So you can pay based on your income, and generally as you get older, your income levels decline. Then when you withdraw the money, you're going to pay a lower interest rate or tax rate. So now, how do you get up to 20% taxed on your dividends? Well, you got to be a 0.05%er, $425,000 a year or more. All right, let's call it 426. And as you can see here, I shouldn't have went over the first part, but as you can see here, 78,000 married to 479,000 married, then you're at 15%. 40,000 to 426,000 single, and you're at 15%. Once you go over 425, 479 for married, you're going to pay 20%. All right, that's it. But why do you care? Let me give you an example of something. If you put down, here's what a lot of people do. Let's say, for instance, I'll use an example later, but I'll show an actual literal example in a second. But let's say you put down $10,000 and you know that PG&E is going to have their dividend later on this month. You put down $10,000 before the ex-dividend date, and we'll get into the ex-dividend date later. And now you're on record, so you're going to get part of this dividend that comes out. In some instances, that could get you $1,300 to $1,500 in dividends from a $10,000 investment. And not only that, you can roll it over to another account for another dividend. So this is why you see stocks rise seemingly for no reason as they get closer to the ex-dividend date. An ex-dividend date is a date of where you have to have bought the share and be a shareholder of record. So if you buy the share after the ex-dividend date, then you will be when 3 months from now happens, then you'll be into where you can receive dividends. So hopefully everybody understands what we're talking about here. But the most powerful thing here is anybody married who makes under $77,000 a year combined, you would pay zero taxes for dividends. Anybody single who makes under $39,000 per year, you have dividend coming in, you pay zero in taxes. This is perfect for people who say, I'm not wealthy, or who, no worries, start. And you don't have to start big either. With the advent of RobinHood and M1 and M1 Finance and Webull. These are online that charge you no commission rates. You can buy shares. And in fact, Robinhood just started where you can partially buy shares like crypto. If AT&T is $35 a share and you only have $10, apparently they're letting you buy $10 worth of the share. I do not know how they're paying out the dividend portion though, because you only have a portion of the share. So I don't know how that works, but I'm just letting you know. I'm just giving you the information. So we're talking about the tax, and so some of you may not be able to read very good on the screen. So I'm bringing up from Smart Asset, bringing up the bracket so you can see for yourself. So the graph, so you can see right here, capital gains rate 0, as you can see. If you make, this is 2019. So if you make under $40,000, you pay 0%. If you're single. These are all single rates. If you make, once you go above 40,000 and you go 40,000 to, what do we got now? 435,000, you only pay 15% on your dividend. And then if you make over 434,000, then you pay 20%. And this is why wealthy people have a lot of LLCs, corporations, because individually they claim they don't make that much money. So this is how you can avoid paying higher taxes. This is how a lot of people who make a lot of money pay no taxes. Think about it. Jeff Bezos, Warren Buffett, Bill Gates, all these guys, right? Stock-wise, they're worth billions, but it's paper, it's stock. They haven't taken that out. They haven't cashed out. They haven't done anything. So in essence, you can own $10 billion worth of stock and people can say you're worth $10 billion. Sure, if you cashed out your stock, you are worth $10 billion. How much income are they making? Right? Their company is making money. Is the company cutting them checks? No, everything they have is in their company's name. So when they're driving a car around, that's in their company name potentially. Whether their house is in a company name potentially. You get tax breaks and tax deductions from companies, and now when you're doing your individual thing, the stock market, you're looking there going, wow, man, I didn't get any income this year, so I qualify for, I got cut $100,000. Okay, I'm paying 15% on the money I generated. So just think about all this. This is what's going on. It's some people are playing chess and some people are playing checkers. And generally, the less money you make, you'll be playing checkers. The more money you make, you'll be playing chess. But guess what? We're here at StopStrugglingNow.com, and I'm teaching you how to play chess. So this is how we do it. All right? So let's get down to if you're married, because a lot of people are married. And you're saying, Eric, I'm married. So you in 2019, you can make up to $79,000 together, and long as your dividend income isn't, long as your income isn't over $79,000, you pay 0 in capital gains. And even if it is over $79,000 combined, but up to 400 and some odd thousand, 490,000 now, you're only going to pay 15%. Isn't that beautiful? And then of course, if you make over, if you're a 0.001%er and you get dividends, you pay 20%. This is why you heard a lot of millionaires and billionaires who make a lot of money. That's why they're like, oh man, you guys should tax us more. That would help out America. And that goes by, news outlets' heads, but they don't realize what they're talking about. They're like, because they make their money on the ways that they can pay less taxes, so they don't really care about being taxed 20% when they make $620,000 a year coming in. Why would they care? That's free money they're getting from dividends, just like you can do. All right, let's get into it. We're going to go through 12 of these things, so please be patient, and hopefully you can understand what the philosophy is behind this. PG&E, which is Procter & Gamble, you can see right here, I'm at dividend.com. And you can check the history. I mean, you can unlock stuff by paying more, but you can see what the dividend's going to be. Now, you might say the share is $124, let's call it. The dividend is only 2.38%. But please, you have to understand, get your mind right. This is free money that you're getting. You didn't have to work for it. You're sitting at your office. You're sitting at your house. Every 3 months, they're cutting you a check. And over the course of a year, every 3 months equals $2.98, almost $3 a year you receive. So when you're a millionaire, and here's a perfect example, they write it out here for you. That $10,000, remember what I was talking about, that ex-dividend date? So an ex-dividend date is the date that you have to own the share by. Let me see if they have it here. Do they have the ex-dividend date here? No, they don't. But they're showing you the payouts, see, every 3 months. And they're paying about 75 cents. So, but here, $10,000, they left their money there to get their dividend, and it generated almost $1,900 in dividend. That's not bad, but that's annually. Sorry, not that time. It's annually. So basically, you divide that by 4, and that generates roughly $450, $475 that they put their $10,000 down, $475, and that's it. But if you're like a Warren Buffett type and you have $120,000 and you put $10,000 down, just start reminding yourself of the numbers. So if you had PG&E, that's about $1,900 that you would have gotten this year. All right. Now let's keep going. Southern Company, electric utility company, their shares are only $64. They also pay roughly $2.50. But see, their yield is 3.89%. But your yield can be higher because you can reinvest your dividend. So when you do get a payout of, let's see what it is, 62 cents per share, you don't have to take the check. You can just tell it to automatically reinvest. So in other words, 62, and they reinvest, that would be, 0.01 share, but you'll have, another piece of a share. But if you had 100 shares, that would be $62. That would buy you another share every 3 months. And then now you'll have, instead of 100 shares, you'll have 101 shares. And now you're getting paid 101 times 248 instead of 100 times $2.48. And that's how you increase your dividend yield, which is what a perfect example, everybody knows Warren Buffett. This is what he does. It's pretty simple once you have a lot of money. And what do they have here? $10,000 returns $2,700 every year. So here we are at $20,000. And if you would have Southern and if you would have PG&E, you would be roughly at $4,000 a year for $20,000 of investment. See what I'm talking about? And it just keeps going. And this is for the month of February. So you're getting a check in January from PG&E dividends. I reinvest is what I recommend. And then Southern Company, a check in February. And let's see if they have the ex-dividend dates down here yet. Yeah, their ex-dividend date, for instance, they don't have the new one, but if it's a November 15th, then we got generally December 15th, January 15th. So that means February 15th, you have to own the share by February 15th in order to get the February dividend. All right? That's how simple it is. So now I'm going over the secrets. Every month you can have dividend checks. And then what's going to happen at month number 3, you're going to start seeing something very interesting because you're going to be doubling up. All right? So here is Coca-Cola, one of Warren Buffett's thing. Why do you think you see Warren Buffett drinking a Coke when he's talking or has a Coke in his hand? He's marketing. He's a marketing genius. Coca-Cola only pays $1.60 a year, but as you can see, their dividend yield is a little under 3%. But again, you're going to get a check in March for the dividend. All right? And here you can see again, After this $10,000, that adds another $1,600 a year. So now we're at $30,000 in theory that you could have invested in the first 3 companies. And at the end of the year, you could be close to $5,000 in your bank account, all because you have dividends. Now start thinking 10 times this to 100,000 because you're a 1%er, right? Instead of 5,000, you have 50,000 coming in. Do you think you can generate generational wealth? Do you think you can be like a Rockefeller, a Carnegie, a Ford, Kennedy, that type of family? Do you think a sports star like a LeBron James, who generates hundreds of millions of dollars, a Michael Jordan, hundreds of millions of dollars, Tiger Woods, hundreds of millions of dollars a year, you can see why their families should be set up for the next 20 lifetimes, as long as we don't have a crash that ends all crashes. But everything being equal, you can understand why sports stars, the first thing they should be taught should be with their first checks. When they get their first $2 million, they should have their first people saying, hey man, put down $150,000, $200,000 into these stocks where you have passive income coming in, and go play your sport. So while you're going to play your sport, that $200,000 could be generating $100,000 or $50,000 per year, and you reinvesting it. By the time a person retires at the end of 7, 8, 10, 12 years, that thing's up to, millions of dollars. And they don't even have to do anything. Whether they made money in their sports, squandered it away, they're set for life. And this is why generational wealth can be done by all sports stars who are in a league who makes millions of dollars. There's no excuse for being broke. So you're not going to be broke. Your next sports star in the family will not be broke. Your next superstar who makes a lot of money in the family won't be broke, because you're going to say, let's do it the Stop Struggling Now way. All right. So here we are at Coca-Cola at 3 months, and we got 1650, and they're producing 4,000. Here's the 4th month. Okay, the 4th month, you're going to want Cisco. All right. So you can see they have put in the ex-dividend date. So see right here, ex-dividend date, if you would have owned the shares by January 2nd, then you would receive a dividend of 35 cents in a few days. January 22nd, that would be the payout. And what would you do? You would just reinvest the dividend. And look at here, a $10,000 investment in Cisco for the year would net you $3,700 in dividend income. So if we go through the 4 months where you have $3,700 from Cisco, you have $1,600 from here. So what is that? $4,300, let's call it. We'll round it off. Let's say 27 more hundred. What is that? 6,000 now. And then we have PG&E at 1,900. We're at 7,900. $40,000, $7,900 in dividend income. Ladies and gentlemen, this is very powerful. Now you can see a lot of people are sleeping, and you don't need to invest. You can start with $50. You can start with whatever the share costs, $35. When I did my video 4 months ago about stocks that I invest in, I believe, like I said, I can't remember what the number was because I never really care. AT&T, I think, was $33 or $34 at the time. They pay 50 cents every 3 months. I get a dividend. I reinvest it, of course. And the shares have went up. So if I was into the market where, let's say I was an investor, a real stock investor who's trying to flip, then I probably might have, because 34 to 40, that's more than 20% on your money. So at that point, there's a determination. But I still did not sell at $40. I'm just saying, I'm just keeping it rolling. Let that dividend check keep coming in every 3 months. And so now, when we get to this 4th month at Cisco, guess what happened? PG&E also is paying out in that month. So now I'm getting a dividend check from Cisco, and I'm getting a dividend check from PG&E because they pay out every 3 months. All right? Because you can see here. See? This is every 3 months. So that's October, or that's July, October, and then now it's January. Every 3 months. So their next one's going to be January, February, March, April. And then what's going to happen? CVS. $72. We're going to keep going the full 12 times, 12 months, all year long. So here, $72. They're paying $2 a year. All right? And there, if you had $10,000, look at here. That's $6,000 annually. So now you can see you could be well into $10,000, $12,000, $13,000 annually from dividend for making a 10, 20, 30, 40, 50K investment. Now you can see what I'm saying is a modest person who's an athlete or who makes a lot of money, who's a 1%er, if they invested $100,000 into dividend stocks, you can see what's coming passively every 3 months or every year if you extrapolate out to every year. All right, so now we're at CVS. And as you can see, $2, 2.73, reinvest, and all this is attainable. These are not outrageous. This isn't some Berkshire Hathaway stock. The most expensive one is PG&E. But Procter & Gamble, the reason why is because if people understand who Procter & Gamble is, when you're going out here buying soap, they're into consumer goods. When you're buying soap, when you're getting a light bulb, when you're out here buying toilet paper, this is like Procter & Gamble products. This is everyday products. This is why they're one of the most expensive ones. And 123 isn't that expensive. If you put aside $123, let's say every month, 20, what is that, 50, not even that, 20, 30, $30 a week from your paycheck and said, I'll buy a share of PG&E stock every month, that's all you have to do. You don't have to act like you need 10 shares or 20 shares or 100 shares. Start with one. Like here, Southern, they're $64. Coca-Cola, $55. Cisco, $47. CVS, $75. All these are attainable. Ordinary citizens, OCs, we can do this, right? Come on, let me know down below. Do you invest in any stocks and receive dividend income? All right? Let me know what you got. Here's Pfizer, the drug company. They're at $40 a share. They pay out $1.52 a year in annual payouts, and they just had an ex-dividend. So right now, if you went and bought shares of Pfizer, their ex-dividend date, as long as you own by January 30th, you're going to get your payout in March. All right? But again, because we're down here, this is month 1, 2, 3. Cisco now is going to get a dividend. I'm going to start getting double dividends. So now I'm getting paid by Pfizer, and I'm getting paid when Coke is a dividend. So now I'm getting 2 dividends when the 6th month comes out. So starting at month number 4, I'm getting 2 dividends. Cisco, PG&E, CVS, Southern Company, Pfizer, Coca-Cola, dividends. And here we are again. If you had them, it's at $4,900 if you had a $10,000 investment for the year in that. So as you can see, you can start doing all the numbers yourself. And you're sitting here going, wow, never thought of it? Of course, they don't want you thinking of that. They want you to go to work every day. All right? Pepsi Cola. Again, another company, Pepsi, worldwide. The reason why theirs cost a lot, because they have water, they have foods, they have sodas, they have a bunch of different consumer items that people consume every day. Whether the economy is good or bad, these items are going to be bought. At least part of their inventory of items are going to be bought in a large, massive quantity because they're worldwide. So they're putting out $3.82 a year in dividends. And look at this, 10,000 turned into 2,000. You can start doing the numbers. I don't know what more to tell you. I'm giving you actual data. You can go to dividend.com and look it up for yourself. And here's AT&T, which I told you guys about before. Obviously, everybody knows their telecom worldwide. Look at this share, $40 affordable. Look at this. They're giving more than $2 a share now. Now it's 52 cents a share apparently. And look at this, 5% on your money annually. Let's see what $10,000 annually does here. Look at this. Oh, and the ex-dividend date's up. So whoever bought or February 3rd. So that's the kind of stuff we're talking about. And as you can see, a $10,000 investment would annually be $1,400 now. All right. So that's AT&T, and that's another month. So we're here at January, February, March, April, May, June, July, August, getting checks. McDonald's, September. McDonald's, one of the most expensive, at $207. But they pay out $5 a year in dividends. And as you can see, $10,000 a year gets you your $3,000. All right, let's see here. We're almost done. Nike. And this is where I have a real problem, because I have a bunch of people running out here, showing up on YouTube, showing up on Instagram, showing up on Facebook, showing up on wherever they can do, TikTok, Twitter, showing these shoes that they're running to Nike, buying for $200, $150, $300, $800, $500, $1,000, special editions, all this crazy nonsense. And they're saying, yeah, I'm going to flip them, or I'm going to do this sneaker nonsense, right? I call it nonsense. Some of you forgive me. I used to play sports, so we got our shoes for free. So that's why my value for sneakers is a lot lower. People used to come over and they'd be like, how come you have a closet full of shoes? And it's because I used to know the reps, or the reps know me, and I used to play sports, and they'd be giving me Nikes, Adidas, what other kind of shoe brand was it? Pumas. I would have all those in my closet, and my friends would be like, how you get all these? And like I said, I used to know the reps. So that's why I don't value sneakers as like everybody does now. But people flip and they make money from them. I understand this. But here's where my problem is. You're out buying $200 shoes, $150 shoes. You can buy some Nike stock and receive, sure, it's only $1 a year, but you could have money coming in for the rest of your life. Well, potentially if they keep paying. But you could have money coming in from owning Nike shares. The shoes you just bought, you can flip them, but now you're talking about generational money. And just think about how many families are out here buying these little $150 Nike shoes, $125, going out before school and buying 4 or 5 pairs, and you could have bought $600, $700 worth of stock and had this in your family every year, buying these stocks of Nike. And here you go. At the time you spend $10,000, a lot of families over 5 to 6 years have spent $5,000 on Nike apparel. Not only Nike shoes, Nike apparel. So you could have $3,000 a year coming in for the rest of, as long as Nike's paying dividends. But yet all you're caring about is these shoes I'm getting to the kids for Christmas, or are these shoes I'm getting for their birthday, or these shoes I'm getting for back to school. I mean, think about it. This is why wealthy people stay wealthy and poor people stay poor, because they got to show and flash and show off some fancy shoes, cars, boats, clothes, stuff that make no money. Unless, of course, you monetize it like you're doing on YouTube or Instagram or whatever, and you're showing off like you're buying gear. Does nothing for helping people, except you can do it. Anybody can go out and buy this stuff. If you have credit, you can buy whatever. You can rent stuff. I mean, come on. I won't even get into that. This is Stop Struggling Now. We're actually making things happen for your future. All you have to do is invest in yourself a little bit for your future. Now let's get down to it. So where else are we going? This is November. And on November, we're going to have Starbucks. How many people is running down to Starbucks spending $10, $12, $15, $20 a day, or every other day, or $20 a week, and their shares are $90, and they're paying out $1.64 annually? Think about it. There's people that I know that are spending like $200 a month at Starbucks. And I'm sitting there like, you don't own nothing, you have nothing, and you could be buying 1 or 2 shares of stock every month and getting some money, creating wealth for yourself. But instead, you don't want to cook yourself any coffee. You want to go down here and have that mocha coffee latte, whatever they call and stuff these days. So here you go. 10,000, 1,900. And here's the last, December. We're going down here and we have Visa. What's in your wallet? We know who Visa is, and the reason why Visa is expensive, you have to think about every transaction, every day they're making money. Every little Visa swipe, they make money. Just like MasterCard, just like Amex, just like everybody. So therefore, this is why their shares cost a little bit more. They pay $1.20. It's only 0.65%, but again, it's just a thought. If you want to add them or not, it doesn't really matter because it's December and you're going to have payouts as you go 6 months back. I believe CVS and I can't remember, Pfizer, I think it's Pfizer. Pfizer and Visa pay out in December. So you don't have nothing to worry about there. And so this is pretty much it. We went through the 12 months of Christmas. This is why in the video that I put out at the beginning of the year, I was like, does it really matter that the calendar says it's January 1st? Because really, every day is another year, especially when you start thinking dividends. And now you can get payouts. And now you can see why wealthy people always mess with the stock market, and they're not running around with the Gucci belts, the Gucci bags, the Gucci craps, and all this other crap showing off, because they're like, their show off is to their friends is, look here on my phone, I just invested $10,000 in Coca-Cola. That's their flex. They're trying to show, where am I making the most money from? They ain't out here showing off with these trinkets, acting like big shots. They're silently assassinating the wealth game. So let's go, ladies and gentlemen. What are you going to do now? Get your mind right. So with all that said, please like, subscribe, and click the bell below so you get the latest updates. And you know it's hard out here. That's why I'm bringing you the real. And that's why I'm trying to tell you, down below in the links, you're going to have that RobinHood so you can sign up and get a free stock once you start. I think you have to put $100 in or more. M1 Finance, there's a link for that app. If you don't like RobinHood, then go M1 Finance. M1 Finance, don't like that, then go to Webull. There's a link down below for all three. They're free. It doesn't cost you anything to buy stock. You have to upload money into the account, and then you can buy these shares, and then you can just sit back and get your passive income, and there you go. We're talking about another stream of income. Remember, we always have those 7 streams of income we're talking about. Earned income is like when you're at a job, when you're working for yourself, self-employed. We have real estate income when you buy a fourplex or apartments or a duplex and you have that money coming in. Now you have dividend income, another stream of income. We got to get up to 7. So we're going to get up to 7. So let's go. You can do this. All right? If you have any questions, always hit me up at eric@stopstrugglingnow.com. And again, I thank you for watching and I thank you for your support. So keep your head up. Keep moving. And I'm out.